Well, hi everyone. This is Chapter 1, Introducing Financial Statements. We're taking a look today at the alternate version of Problem 1-7, 1-7A, and we're looking at Part 1 and 2 initially. So the problem reads, Gabby Graham started the Graham Company, the new business that began on operations on May 1st. Graham Company completed the transactions during its first month, and here they all are, May the 1st on down through May 31st. So Part 1 says, arrange the following asset, liability, and equity titles in a table like Exhibit 1.9, cash, account receivables, office equipment, accounts payable, common stock, dividends, revenues, and expenses. So, like Exhibit 1.9, I've got something laid out here for you. When you get into Connect, though, this will already be done for you. So just a quick look at the first part, setting up the table. In Part 2, things get a little bit more involved. Now it says, enter the amount of each transaction on individual items of the accounting equation. Do not determine new account balances after each transaction. In parentheses in red, it says, enter the transactions in the given order. Enter reductions to account balances with a minus sign. So when you do that in Connect, enter a minus sign, then the number will end up being in parentheses and notate that it is a negative number. So problem 1 says, G. Graham invested $44,000 cash in the company in exchange for its common stock. Well, what accounts were involved in this transaction? Well, let's look closely. Somebody took $44,000 out of his pockets and put it into the pockets of the company. So from the perspective of the company, all of a sudden the company has more what? More cash. How much more cash? $44,000. Now, what is the other account involved in this transaction? Well, the company, in exchange for that cash, issued common stock certificates to Mr. Graham. How much did they issue in common stock certificates? $44,000 as well. Next transaction, May 1st, the company rented a furnished office and paid $2,300 cash for May's rent. So what accounts were involved in this transaction? Well, we know cash is one. Cash went down by $2,300. And the other is a rent expense. So rent expenses or expenses went up by $2,300. On May 3rd, the company purchased $1,860 of office equipment on credit. Oh, so we know they definitely got the office equipment, right? That's one of the accounts. They got office equipment of $1,860. But notice they didn't use any cash right now. Instead, they've incurred a liability. They're going to pay that cash later on in the future. So a new liability called an account payable was set up for $1,860. Next up, the company paid $800 cash for this month's cleaning service. So we know one account was involved, cash. Cash went down by $800. And it was for this month's cleaning services. Well, that's an expense, cleaning service expense more precisely, but it's just lumped all together in this worksheet under expenses. The company provided consulting services for a client and immediately collected $5,300 in cash. So what were the accounts involved in this transaction? Well, right off, we know that cash is one. They collected $5,300 worth of cash. And what was that cash for? Well, it was for what the company's in business to do, and that's provide services. So those are revenues to the company, also in the amount of $5,300. The company provided $2,700 of consulting services for a client on credit. Okay, so like before, they did something, they provided services, but whereas on the 8th they got cash for it, they're not getting cash right now. The customer is going to send that in later on. So the company has a different asset other than cash. They have an IOU account called an account receivable. So account receivables will go up for the $2,700, and then revenues as well go up for the $2,700. On the 15th, the company paid $730 cash for an assistant's salary for the first half of this month. So what accounts were involved there? Well, obviously cash was involved. Cash went down by $730 to pay that salary. And then what was that for? Well, it was for an expense called salary expense that once again just gets lumped in together under all of our expenses here. Last up on this half of the transactions, the company received $2,700 cash payment for the services provided on May 12th. Okay, remember, they provided those services, they provided it on credit. That credit was an account receivable for $2,700. So customers owed them $2,700. Well, here in May 20th, the customers are paying that $2,700. So this 2,700 IOU is actually going to go away, right? Yeah, that's got to be a negative 2,700. And then what are they getting for that? They're getting cash, so cash goes up by a positive 2,700. Okay, let's take a look at the next half of the transactions on the next slide. So it says the company provided 3,900 consulting services on credit. So on May 22nd, they provided more services. They did it on credit. So it's revenue to them right now, but they're not getting cash now. What are they getting instead? That IOU called the accounts receivable for $3,900. And then on the 25th, that customer paid their IOU off. So this $3,900 is going to go away with a negative $3,900, and now they're going to get cash from that customer. The company paid $1,860 for cash for the office equipment purchased on May the 3rd. Okay, remember they purchased that office equipment on May the 3rd. They didn't give up any cash yet, but they did have the equipment. What they had was that account payable that we saw on the previous slide. Now that account payable is going to go away. We're going to put in that as a negative $1,860 to show that account payable being paid off. And what are they sacrificing to pay off that liability? Well, the company's sacrificing cash. So cash is going to go down $1,860 as well. On May 27th, the company purchased $90 of advertising in this month of May, local paper, and they did that on credit. Cash payment is due June the 1st. Okay, so is cash involved on the 27th? Well, no, because they're not paying for this ad until later on. But they're getting this ad for the month of May, so they're definitely going to have advertising expenses of $90. And they've got an IOU for that $90 that they've got to pay out, an account that they've got to pay out, something they're liable to do for $90 as well. So accounts payable goes up for $90, and expenses goes up for $90 as well. The company paid $730 cash for an assistant's salary for the second half of the month. Okay, so they paid the cash of $730 for the assistant's salary. They're giving up cash of $730. That salary is a salary expense, so cash is going to go down by $730. And we add to our expenses of $730 as well. And more precisely, that would be called salary expense. Okay, we're in the home stretch. Just 3 more. Hang in there. So the company paid $300 of cash for this month's telephone supplies. So what happened to cash? Did it go up or down? Cash went down by how much? $300. And that telephone bill that they paid, what is that to the company? It's an expense. Telephone expense. So expenses go up by how much then? $300 as well. 2 more and we'll be done. The company paid $260 cash for this month's utilities. What will be the 2 accounts involved? Really similar to what we just did. Well, hopefully you said cash and expenses. What's going to happen to cash? It's going to go down by $260. And expenses, the utility expense lumped into all expenses, will go up by $260. Perfect. Now the very last one. It says the company paid $1,800 cash in dividends to the owner, the sole proprietor. So the company paid $1,800 in cash for dividends. What accounts will be involved in this transaction? See if you can figure this one out. Well, hopefully you said cash and also dividends. What's going to happen to cash? Is it going up or going down? It's going down by $1,800. And what's happening to dividends? It's going up by $1,800 as well. Alrighty, so those are some tough transactions. Be sure you go back and take a closer look at the video here. The last part is now we take this entire worksheet and we just total things up. So all of the cash, we started off with $44,000 of cash. We paid some bills, got some money in, paid some more bills, got some money in, etc., etc., etc. So after all was said and done, the month of May, we ended up with how much cash? Well, you just total all this up, and cash totaled up to $47,120. Okay? Now let's total all the other columns. Account receivables. Remember those customers? They got some services, some consulting services. They got those on credit, so no cash was collected yet. But then when cash was collected, that credit was paid off. Then that IOU was created again on the 22nd. another one was created on the 22nd, sorry, and then it was paid off on the 25th. So total that up, and account receivables are actually zero by the end of the month. For the office equipment, we have the equipment we bought, that's $1,860. The equipment was bought on credit, but then it was paid off on the 26th, so that cancels that out. But we still owe that $90 for that ad that we placed. So the account payable has a balance of $90. Common stock, so stockholders contributed $44,000 and we issued $44,000 worth of common stock certificates. So the common stock balance is just $44,000. We paid out dividends of $1,800. We'll be subtracting that out later on, but we just enter it as a positive number just as it is. Total all of our revenues for all the things that were sold during the period. And total all of our expenses. Now, typically we would detail each of these expenses separately. The salary expense, the cleaning expense, the rent expense, etc. But for right now, we're just going to lump them all together, so total them all together. And total expenses are $5,210. And with that, we've completed problem 17A, the alternate version, part 1 and 2.